Assalamualaikum and good morning everyone. My name is Nurul Fatin binti Azmi. In this assignment, our group has conducted a financial ratio analysis on Grand Flow Berhad.
So I start with the background of Grand Flow Company.
For over a decade, Grand Flow Company has been developing effective data processing and partnership system for diverse company and international establishment. By specializing in enterprise data collection and collection system solution, better known as automatic identification and data captures, their specialized team bring together the right hardware and software to create the ideal AIDC solution for every business need and requirement. In mid-2013, Grand Flow ventured into land production and complete the purchase of 50,004% of Inoceria Sendian Berhad. The group successfully diversified its business activities to include land production on 12 August 2014.
Two development projects are located in mainly Penang, capturing the high growth opportunities in Northern Peninsula, namely Berhad Business Park and The Glade. Berhad Business Park is a commercial development located in Batu Kawan Industrial Centre. It is well placed to capture the market for commercial properties that are geographically focused. The Glade has luxurious home in Bukit Mertajam. The company has also established a new integrated township in Perak called Mahkota Kampar. This interconnect township provides 34 acres of live farming opportunities, which are to establish a perfect home, to develop a happier family, and to be a part of vibrant community while enjoying the magnificent abundance of nature. Grand Flow Berhad has expanded its business not only in Malaysia but also in China and Hong Kong. In Malaysia, it has three company groups which are Grand Flow Speedway Sendian Berhad, Grand Flow Electronic System Sendian Berhad, and Grand Flow Capital Sendian Berhad. This company is led by Datuk Sri Yap Ngan Choi as their executive chairman. He has been assisted by other several management team. Next is liquidity ratio. Liquidity ratio is divided by two, which are current ratio and acid test ratio. The first liquidity ratio is current ratio. From the calculation, we can see that Grand Flow Berhad's current ratio of 48.12 times is higher than the industrial average. Having a ratio of 48 and 12 times means for every 1 ringgit of current liabilities, the company has 48.12 ringgit of current asset to cover its current liabilities. A higher current ratio is always more favorable than a lower current ratio because it shows the company able to pay its current liabilities when the need arises, but for Grand Flow Berhad, they have too high current ratio, which is not good for the company performance. Thus, the Grand Flow current ratio indicate that the company has poor performance compared with the industrial average. Having too high current ratio means that the company has excess cash, which might reduce its profit, which implies interest cost. It also indicates that the management not efficiently using their asset. Next is possible cost. From the Grand Flow financial position statement, the current asset of 45,517,619 are too high. Meanwhile, the current liabilities only 945,843. We can assume that the company is not efficiently using its current asset or its short-term financing liabilities. There are no financing expense in company income statement, so the possible cause of too high current ratio is company does not do any financing activities. Other possible is company might be leaving workable asset on the sideline, such as company does not use the cash to expand operation or improve equipment. There are some suggestions for improvement. Firstly, the company can spend more cash optimally. Cash is a current asset, so that by spending more cash can reduce the current ratio. Company can use the cash for several purposes such as purchasing the fixed asset or expand their operation. The company also can use the current asset to do some financing activities like pay more dividend to investors. Company can use the current asset to do more investment for purpose of generating profit. Besides that, company also can increase the short-term loan rather than the long-term loan to reduce the current ratio. Furthermore, the linear cycle of working capital will ensure that the current assets are controlled and reduced. Second is acid test ratio. Company has a higher acid test ratio than industrial average. The higher of acid test ratio, the better the liquidity of the company and financial health. It means that the company able to pay its obligation without liquidating its inventory. However, for the Grand Flow Berhad, they have a too high acid test ratio, which is not good for the company. It indicates that the company not putting its short-term asset or cash to good use. The possible cause of the extremely high acid test ratio because the cash is accumulated and either company does not use the cash to reinvest, return to the shareholder or put to productive use. It also because the company has high account receivable and it may indicate in collecting problem. For the improvement, company need to reduce the amount of acid test ratio. Company can use cash to make some investment, purchase the fixed asset or expand their business. Same as to current ratio, company needs to increase its short-term liabilities by making short-term loan to reduce the acid test ratio. The company can also use the current asset to do some financing activities like pay more dividend to investors. That's all. Thank you.
Move to leverage ratio. First, debt ratio. Debt ratio for Grand Flow Berhad is 0.99% and industry average is 25.27%. Debt ratio of Grand Flow Berhad lower than industry average and the company easily get a loan or additional borrowing from creditors. The company also has lower financial risk. Possible causes. Grand Flow has lower liabilities in 2019 amounted Rm900,000 while in current liabilities decreased by Rm17,000 million and there is zero amount for non-current liabilities. The company also has made payments of its liabilities and not made any loans from any institution. Recommendations for improvement debt ratio. First, the company must issue additional or new stock to investors, list their asset and increase sales to improve their profit. Next, time interest earned. Time interest earned is 0 times and industry average is 192.20 times. Grand Flow Berhad has time interest earned lower than industry average and the company not able to meet its interest obligation. Possible causes. The company has a lower time interest earned due to zero amount on interest expenses and the company don't make any loans or additional borrowing from any institution. Profit for company Grand Flow Berhad also has increased to Rm1 million compared to 2018. The company has lost amount Rm7 million. Recommendation for improvement. Grand Flow Berhad needs to either issue debt or use equity as source of capital and increase their earning. Last, for leverage ratio. Debt to equity ratio. Debt to equity ratio is 9.99% and industry average is 3.64%. Grand Flow Berhad has higher debt to equity ratio than industry average and more risky to creditors and investors. Possible causes. Share capital from company Grand Flow Berhad is increased from Rm62 million to Rm66 million and the company has invested large amount of money in asset and operation and use more equity than their liabilities. Recommendation for improvement debt to equity ratio. The company must improve inventory management and reinvest money by applying additional borrowing from financial institution.
Assalamualaikum. My name is Alia Safia Hazali. Next, I will proceed to profitability ratio. First, gross profit margin. The percentage of sales remaining after deducting the cost of making such sale. The gross profit margin for grain flour is 100% and industry average is negative 76.65%. The ratio of grain flour has much better than industry average because a higher gross profit margin means the company has more cash to pay for the costs and expenses. Recommendation for this company: need to rethink the aspects of the business or revise the business strategy for improvement, maintain the good management, and try to achieve the higher sales target. Operating profit margin derived after deducting all costs and expenses excluding interest charge and tax from the sales figure. As we can see at the figure, grain flour Berhad is making higher operating profits than industry average. Possible causes: every ringgit of income that is remaining RM0.24 after operating expenses have been paid. The company made sufficient money from its operation. The company has more money to cover non-operating costs. Recommendation for the company: reduce cost of sales and operating expense. For example, grain flour Berhad need to streamline their operation and reduce operating expenses such as embrace technology instead of manpower. The third ratio, net profit margin. The ratio is not useful for companies making losses because they don't have profit. These ratios indicate the pricing strategy adopted by a firm. As we can see, there are a huge gap between company ratio and industry average. This is because higher net profits margins enable a company to convert more of its sales into profit. Having good cost control and strong pricing strategy. Increase in sales from completed properties. Recommendation for this company: boost revenue by increasing sales because profit margin increase if cost of goods sold remains constant percentage of sales. Okay, now I will explain about return on total assets. Indicate the management's ability to make profit from the firm investment in asset. As we can see, grain flour Berhad 1.13%, industry average negative 1.39%. For every 100 ringgit of assets, result to RM1.13 gain to the annual earnings. This is because the company earns more money than it's spending. It can expect to improve and even increase its return on assets. Our recommendations to this company: constantly reduce asset costs and increase income. Company can reduce asset costs by monitoring asset expense monthly. Like example, reduce inventory costs by managing level of inventory to reflect with sales expectations. The last ratio for this ratio is earning per share. Return on equity ratio essentially measure the rate of return of the common stock that company receive on their stockholders. Grain flour Berhad ratio for ROE is higher than industry average, which means the ratio is good for the shareholder. The possible causes: higher earning per share is increasing the net profit, decrease in the total count of share. Our recommendation for this company is grain flour Berhad can raise their earning per share by simply buying back their own shares. This reduce the amount of outstanding stocks. That's all for profitability ratio.
Assalamualaikum and good morning everyone. I will present the common size ratio of grain flour Berhad. We choose vertical common size analysis to calculate the ratio for grain flour Berhad. Based on the common size statement, we can see the percentage of non-current asset and non-current liability for both 2018 and 2019. The amount of total asset is decreased by 0.753% from 2018 to 2019 due to the decreasing in amount of investment in subsidiaries. For amount due to subsidiaries, it shows 0% for 2019 instead of 3.61% in 2018. Amount of PPE for 2019 show an increase by 112.54%. It might be grain flour may purchase new equipment in 2019. For fair value through profit or loss, it show an increase of 42.36%. It is a good, but however, it still cannot increase the amount of non-current asset because there is a huge decrease in investment in subsidiaries. Now we move to the non-current liability. It shows that there is no liability for 2019 compared to 2018, which has amount due to director. However, in 2019, the percentage of the non-current liability turned to 0% because the company has settled all the non-current liability, which is amount due to director. So, the company have managed properly toward its debt, as the company has a little debt in 2018 and it's turned to zero when it comes to 2019. Grand Flow Berhad has recorded a profit for 2019 and loss for 2018. For liquidity, both ratio, asset test ratio, and current liquidity ratio indicate the extremely high than industry average. It is not good because the company not use their cash and asset well. Next is leverage ratio. Debt ratio is lower than industry average. It is good for the company because has lower financial risk. For times interest earned, it shows that 0% for Grand Flow Berhad, meaning that the company not able to meet its interest obligation. Debt to equity ratio is higher than industry average. It is risky for the company in settling their debt to equity. Last but not least is profitability ratio. It shows a good result since for the ratio, it indicates mostly higher than industry average. It was good to investment for the shareholder because the Grand Flow Berhad making higher profit. In conclusion, it shows that the unsatisfactory company performance, as it may indicate that company does not use their asset and liability efficiently. Company need to use their current asset rather than letting it accumulate by using it to generate more profit and to attract more investor. That's all from us. Thank you.